Typically, when somebody wants to buy a house, they call a lender, they get a pre-qualified for a mortgage loan, they find a house, they put an offer on it. 30 days later, they close on it. They have a new debt, which is a mortgage. How does that differentiate from, like, say, a traditional mortgage?
Yeah. So what we do is we don't create debt. We create an investment partnership around the home. And so the way that works is that the customer, the first time buyer, comes to Ownify, they qualify, we underwrite them, we give them a budget, and these are generally starter homes. So think three, four, five, $600,000, depending on the market. And when the customer finds a home, we buy the home as an all cash purchase. By we, I mean Ownify. And what we do is we set up an LLC as the entity that holds title to the home, and the customer becomes a member of that LLC, or an investor effectively. The LLC issues 10,000 shares, or bricks as we call them, and the customer buys those bricks over time while living in the home. So rather than buying the home all at once with debt, pledging the title to the mortgage lender, and then paying off that debt over 30 years, which is kind of the traditional way, what we're doing is we're allowing the customer to buy into ownership by virtue of buying more shares, more bricks in that LLC over time. So you start with 2%, you get to 10%, let's say after 5 years, you can keep going and build equity, but you don't have debt in the sense that you don't have the obligation to ever pay off 100%, right? Or buy 100% of the LLC. You can buy as little or as much as you want. And effectively, you're renting the rest. You're renting the fraction that you haven't bought. So think of Ownify really as a fractional ownership platform that allows you to own a fraction of the home and then rent the remainder, right? And the analogy of bricks we use, most homes in the US aren't made out of bricks anymore, but you stack your own bricks and you rent the bricks that you rent the stack, effectively the balance that you haven't bought, right? And that fractional ownership allows us to reduce the down payment. It allows us to reduce the monthly payment, yet at the same time give people the ability to pick a home off the MLS, right, with their agent and say, this is the one I want. It's for sale on the market. We can create an all cash offer, put you into that home, right, and give you the ability to live in it and build equity over time.
Okay. So fractional ownership, that's kind of a buzzword being thrown around real estate right now. So that's what it sounds like to me. So essentially, Ownify purchases the property, basically breaks it down into shares or bricks, and that tenant / first-time home buyer that they would be can buy shares of the property as they go. And now, as they buy more shares of that property, does their rent decrease? Or does that kind of stay the same until it's all
You
bought?
got it exactly right. Right? If you, as you increase your share, your number of bricks, right, the share that you have to rent, the number of bricks that you have to pay rent on decreases. So effectively over that 5-year horizon, what we do is there's a fixed monthly payment, but within that fixed monthly payment, the fraction that goes towards rent decreases and the fraction that buys equity increases, right? And so, yes, your rent over time goes down.
This is an interesting approach with this, because if let's say that you have a tenant there, let's say we had a property, Josh, and we had a tenant in there, and we decided to, get it off to Ownify, sell it to Ownify, or somehow, however that works, we would get into that. But essentially, they could just buy shares of that property, and instead of having a mortgage debt, like you said, you're buying more interest in that property. Now, is that interest open to other investors too, or is it just exclusively to that said tenant that we're talking about who wants to own the property?
Yeah. So the tenant, or the Oni, as we call them, has the exclusive right to buy equity over time, right? And they do that by making their monthly payments, right? And they're buying those bricks. And the bricks change value over time, but they're always buying, a fixed amount of dollars and a variable number of bricks per month. Now, the balance, the other 9,800 bricks on day one, right, are funded by investors. And the model we've built there is that we've launched something called the Ownify Home Fund, which is open to accredited investors. That's a Reg D 506C fund. And that fund invests in all the homes across the portfolio. So, Rob, to answer your question, as an investor, you couldn't pick, let's say, Joshua's home, right, and invest in Joshua's home, but not in Frank's home. You invest in the fund, and the fund in turn invests in all of the homes. And so the reason we did it that way is to make sure that we have one, a diversification for the fund, right, and for the investors, and also we didn't want to burden the investors with, underwriting and picking the homes, and potentially having exposure to bad decisions there, right? So in a long-winded way, the answer to your question is you can't invest in a single home directly. You can invest in the fund that holds bricks in, a portfolio of homes.
Okay. Well, let me throw a scenario at you. Let me put it in a different role. Let's say I'm an investor. I own a rental property, and I have a tenant in there, long-term tenant, doing great, decent cash flow. I got the house appraised. They're telling me it's an entry-level house, so it's $400,000. That's what the appraiser tells me.
Yep.
I got 50-50 on the house. I got 50% debt, and I got 50% equity. Now, I want to get that $200,000 out of that house because I got some young Gen Z investors that told me that there's some cryptocurrency meme tokens that are going to the moon, and I cannot wait to get that $200,000 out so I can throw it all in there and pump up Shiba Inu. Yeah. So what do I do in that case? Because usually what I'll be faced with is, okay, my tenant wants to buy it. Great. I'll call up my attorney, draft up some paperwork for maybe $1,000, pay my closing costs, might be less than 1% of the value of the property, and transfer ownership. They got a loan. They bought it. That's one option I can do, just sell it to them directly. Another thing I can do is, and which this actually, Ownify kind of sounds like a very interesting take on seller financing.
It is. And so we love that scenario, right?
Yeah.
So to the extent that you are an investor, you have a rental property, you have a tenant that potentially is interested in buying it, right? We can help you do that. And there's two paths here. The first one is sell the home to Ownify. Let's say your equity is $200,000. We pay you out the $200,000 and you're done. You walk off, you put that money into the meme, Dogecoin, whatever, crypto, and good luck to you. And, don't call me afterwards. The other scenario is a potentially even more interesting one, which is, this is the scenario where you don't want to put it into crypto and maybe you're done managing the property, but you want to continue having cash flow. So what we've structured there for investors and landlords is the ability to sell a fraction of the home to Ownify. And so what we do is we buy out a stake of your equity, not all of it, but a stake. So let's say in this scenario, we buy out $40,000 or $50,000. We run the program over the next 5 years, take the tenant that you have, turn them into an ONI, right? Give them the ability to buy bricks. We put the home into the fund, but you stay as an investor in that specific LLC, right? Which is now holding title to your home. And you benefit fractionally from the income that LLC generates, right? And you effectively roll a portion of the equity that you had in the home into that LLC, which gives you cash flow for the next 5 years or however long it takes the tenant to fully buy out the property, right? So there's the sell it all, be done, move your money into crypto, or I want to Ownify, help my tenant buy the home, right? And effectively use Ownify to structure a seller financing arrangement where I don't have to worry about the performance. I just get my, passive income every quarter. And so either scenario works. What's interesting, if you think about fractional ownership, for landlords in particular, for investors, what's interesting about fractional ownership is the alignment of incentives and the change in behavior we've seen. So if I look at our current portfolio, are all starter homes, right? $300,000-$400,000. The average FICO in the portfolio is 740. So these are pristine people with great credit. They have very, I'd say solid incomes. So they make monthly payments on time. We've not had a single late payment. We've not had a single day of vacancy because customers pick the home, we buy the home, and they start payment from day one. And we've not had any turnover, right? So no vacancy, on-time payments. And what's interesting from this co-ownership perspective is we've seen about 60% lower maintenance costs on the portfolio compared to SFR because people take care of the property, right? The goal is ultimately to own it. They're owning a fraction of it already. Their fraction increases every month. So they're acting much more like owners than like tenants. And so all of those things together ultimately result in higher yield to the investor, right? You're just building a portfolio of homes that performs better than your standard SFR portfolio. And so as you think about that scenario, Rob, that you outlined, right, an owner or an investor who has maybe 5 or 10 properties, there's an opportunity here to increase the yield on that portfolio by selling it fractionally, kind of through the Ownify program to the tenants that are in there or potentially new customers who are interested.
All right, ladies and gentlemen, if you like this video, go ahead and hit that subscribe button. Like the video, leave a comment below. Check out the description below and visit ownify.com. With that, thanks for watching. Thanks for listening. See you soon.